Hi, good morning, everyone. Yeah, good morning, good morning. Maybe we'll just wait for another 2, 3 minutes so that the others can log in. As of now, we have like 18 attendees. So maybe another 2, 3 minutes and then we can officially start. Okay. Okay. Hi, good morning, everyone. Let's start. Let's resume. So, hi, my name is Kushagra, and I'll be taking you through this subject of financial accounting for managers. Now, this subject, the main intention of the subject is not to make you an accounting ninja or let's say make you an expert in accounting. Now that's the domain area of an accountant, a chartered accountant, and let's leave it up to him to do it. The main intention of this course and the subject is to make sure that you are familiar with the financial terms. So let's say if you're interacting with someone and somebody starts throwing financial jargons at you, it should not appear as Greek and Latin for you. Similarly, let's say if you are looking at a company and you want to decide whether it's a good company or a bad company, then what are the things that you need to look into? Which are the financial statements that you're supposed to look at? And how do you do the interpretations? So the main aim of this course is all about analysis, and it's less, or it's got very little to do with basics of accounting. So people who are not from the commerce background, they should not have a problem with this subject as such, because we'll be starting with the basics. So again, I'll start sharing my screen so that we can just go through what we'll be doing in today's lecture. So if I look at today's lecture, so today what we'll end up doing is, in session 1, we will go through the introduction to financial statements. So we look at what do you mean by financial statements, what are the components of financial statements. And basically, if you look at the financial statements, they'll consist of 3 things, which is a balance sheet. It'll consist of an income statement or a profit and loss account, and a cash flow statement. Now, again, we'll deep dive and delve into each of these, and we'll spend a lot of time today understanding what is balance sheet, what are the components of balance sheet, what's an income statement, what are the components of income statement. And then finally, we'll move to a cash flow statement, which will talk about the various sources through which money is coming in and going out of the company. So balance sheet will basically talk about assets and liabilities. Again, what's an asset, what's a liability, we'll discuss it over the next 5-10 minutes. Income statement or the profitability statement will talk about how profitable the company is, how much revenue the company is generating, what are the expenses that the company is incurring. And like I said, the cash flow statement talks about money coming in and going out. Now, once we're done with this, we'll also look at the life cycle of a company. So just like you have a product goes through different stages. So you could have the introduction stage, the growth stage, the maturity stage, and the decline stage. Similar is the case with companies. When the companies start, it's a startup, so it's an introduction stage. Slowly and steadily, they move towards the growth stage. They attain their market share, and they have their set of customers and the market base. Then they reach the maturity level. And finally, slowly and steadily, if the company doesn't change, if the company is not able to adapt to the changes that are happening, then it moves into the declining phase and the company would go into liquidation. So this is what we will be covering in today's lecture. When we look at the life cycle of a company, I'll be linking it with real life companies. So I'll take up companies like Peloton, Netflix, Coca-Cola, and Toyota, and we look at different stages and what happens when companies move from different stages. So at the introduction stage, what will be the position of the balance sheet and the income statement? When the company moves into, let's say, the growth stage or the maturity stage and the declining stage, what will be the position of the balance sheet and the income statement? Cash flow statement, I'll just touch upon it today because we need to cover it in the live session 2. So when we move to live session 2, that's when we look at the life cycle of a company and how the cash flows change when the company moves from the introduction stage to the declining stage. So this is what we'll be covering in today's lecture. Then if you look at, let's say, the next session, the session 2, where we talk about various accounting concepts and conventions. So what are, just a second. Okay, so I've got accounting concepts and conventions. So if you look at accounting concepts and just a second, people, can you see the slides or, I mean, there's some problem. Can you see the screen? Yeah, so I've just made it too small. Okay, you want me to increase the size? I'll just do that. Yep, is it fine now? Okay, fine. Now, let's look at live session 2. If you look at live session 2, where we cover various accounting concepts and conventions. So we look at the different concepts and conventions, the logic of having these concepts and conventions. And the basic reason is to ensure that there is standardization. If we don't have these concepts and conventions, different people will have their own interpretations, and then it becomes difficult for me to look at different companies and do a comparison. Then we look at users of financial statement. So users of financial statements could be, let's say, the government, it could be the tax authorities, it could be an investor, it could be the top management, an employee, and different sets of people. and what is it that these people basically look into financial statements. So we'll cover that in uses of financial statements. Then we look at something which is known as an accounting equation. Now, accounting equation is a very simplistic way of making a balance sheet. So somebody who's got no idea about, let's say, finance, who's not from the finance background, and if that person wants to make a balance sheet, then an accounting equation will help that person to make a balance sheet. So we look at an accounting equation where we don't look at, let's say, debit and credit, but we just look at basic items like what's an asset, what's a liability, what's an income, what's an expense, and accordingly we make a balance sheet for a company. And then finally, we deep dive into what's a cash flow statement. So in today's session, I'll just cover the basics of a cash flow statement. Live session 2 is where we'll focus more on the different aspects of a cash flow statement and the life cycle of a cash flow statement. So that's your session 2. And then finally, we have session 3. Now, in session 3, we move into something which is how do you analyze a financial statement? And the basic tool for analyzing a financial statement is your ratio analysis. Now, ratios could be of different categories. I could have liquidity ratios, I could have profitability ratios, I could have solvency ratios, something that we covered in live session 3. Liquidity ratio basically focuses on your short-term repayment capacity. So let's say you're supposed to make a payment to someone over the next 3 months, 6 months, 8 months. Do you have enough cash, liquidity, and funds to make that payment, or you're struggling? That gets captured in liquidity ratios. Profitability ratios will talk about how profitable the company is. And again, whether we are looking at profitability from the point of view of all the people who've invested money, or we are just looking at it from the point of view of the shareholders, again, we'll have different types of profitability ratios. Solvency ratio is nothing but an extension of, let's say, liquidity ratio, because liquidity ratio focuses on your short-term repayment capacity. Solvency ratio focuses on your long-term repayment capacity. So let's say I've taken a loan. Can I repay off that loan over the next 5 years, 10 years, 15 years or not? Is it that I've taken too much of debt? Do I have enough cash? Can I go ahead and take another loan and get some funding from a bank, or the bank would reject it? So all this would get captured in typically a solvency ratio. So we look at different categories of liquidity, profitability, and solvency ratios in live session 3. And finally, when we move to live session 4, which is the last session, we look at the remaining ratios, which is your turnover ratios. So turnover ratio is nothing but an efficiency ratio, which basically talks about how efficiently the company is being managed. So that efficiency could be in terms of how you're using your fixed assets, your current assets, your capital, so on and so forth. So we look at turnover ratios, different categories of turnover ratios. Then we look at something which is a Dupont analysis. So Dupont analysis is nothing but I'm looking at what's the return that the company has generated for the shareholders. And I want to deep dive over here and say that, okay, let's say I've got a return of 20%. I want to find out why is it 20%. So is it because, let's say, I've taken more debt that I've generated a return of 20%? Or is it that, no, I'm a company who's able to manage the cost that I've generated 20%? Or is it that I'm able to manage my assets properly because of which I've generated 20%? So this is where we look at Dupont analysis. So Dupont analysis is nothing but segregation of, let's say, the return that you're generating for the equity shareholders, looking at various factors which influence the return for the equity shareholders, and then decide, okay, this is a gray area for me, this is where an improvement is needed, and this is where I'm good, and maybe, let's say, I need to maintain that sort of a profitability. So Dupont analysis helps company in finding out which are the gray areas, the red areas, and they can focus on those areas to increase the profitability. And then finally, we look at other financial tools. So if you look at other financial tools, basically it's your comparative and common size. So let's say I want to look at a company and I'm looking at 2 years of data. I want to find out what's happened in the company over the last 2 years. Supriya, don't worry, we'll be looking at what's an equity shareholder. Okay. So over here, what I'm doing now is I'm just giving you an overview of what I'm going to cover in the next 4 sessions. So I haven't started with anything. So we'll cover what is equity shareholder and everything in detail. Don't worry. Okay. So we look at financial tools. Like I said, we look at comparative and common size. So comparative is when I look at data for 2 years. So maybe I look at data for 2019 and 20, and I want to find out what's happened in the company over the last 2 years, whether the sales have gone up, whether the expenses have gone up, whether the company has expanded and the assets have increased, so on and so forth. So that's a comparative statement. Then you also have something which is known as a common size statement. And this is basically used when I want to compare companies in the same sector, but they're of different sizes. So let's say I've got a company like Asian Paints. Asian Paints is the biggest paint company in the country. And I've got Berger Paints. Berger Paints is like 40 or 50% in terms of size compared to Asian Paints. So let's say if I compare these two companies on the basis of absolute numbers, so maybe Asian Paints could have a sales of 10,000 crores, Berger Paints could have a sale of only 4,000 crores. And if I look at the profit, maybe Berger could have a profit of 1,000 crores. Asian Paints is having, let's say, a profit of 2,000 crores. So if I just look at absolute numbers, I'll say Asian Paints is better because it has a profit of 2,000 crores. But Asian Paints is a bigger company. So for a bigger company, 2,000 crores makes more sense, or for a smaller company, 1,000 crore is more important. So in common size, we don't look at absolute numbers. We convert everything into a common base in terms of percentage, and then we start looking at companies. So common size is basically used when companies are of different size. I've got a big company and a small company. Maybe I've got a startup and a company which has been into existence for the last 30, 40 years, and I want to compare them and see which company is doing well. So this is what we'll be covering over the next 4 sessions. So now let's move to the first session. So like I said, in the first session, we look at balance sheet, we look at income statement, and we look at the cash flow statement, and then the life cycle. Anything that you want to say? Otherwise, we start with the balance sheet, income statement, and the cash flow. So can we move forward to the balance sheet, the income statement, and the cash flow statement? Okay, fine. Now there's one thing that I'll be doing now. I'll be converting my laptop into, let's say, I'll be using my stylus. So I'll have to switch off the camera, because now if I convert it, then you'll end up looking at the ceiling. So I'll just switch off my camera now, because I'll start using the stylus and the whiteboard now. Okay, so just give me a second. Okay, so let's look at what is a financial statement and how financial statements come into existence. Now, the first thing that will happen is companies will have transactions. Okay, now these transactions could be your day-to-day transactions. This could be, let's say, a one-off transaction. Okay, I've got a question. Will we receive the slides post the session? I think I've sent it to the team, and they would have shared it with you. So I'll just get back with you. Maybe, let's say, after the session, I'll have a word with the team, and I'll just let you know. Okay, so I'll have transactions. So these transactions could be, for example, I've done a sale. So I'm selling my goods. So I'll have sales transactions. Maybe I could have something like a purchase. I've purchased material which will be used for producing goods, and then those goods would be sold. So I could have different types of transactions, and these transactions, when they are collated and they're recorded, then they're recorded in something which is known as a journal. So all transactions which happen on a day-to-day basis, I record it in one place, which is known as a journal. So that's like a dump of all the transactions. Now, from this journal, what I end up doing is I make a ledger. Because this journal, let's say, maybe on 1st of April 21, I had transactions for sale and I had 5 transactions of sale. So I sold goods to 5 different parties. And I had, let's say, 1 purchase or maybe 2 purchase transactions. So in a ledger, what I do is I make different accounts of, let's say, sale. I make an account for purchase. If I bought an asset, maybe I bought some furniture, so I'll have a furniture account. And I'll take all these sales that have happened and I'll record it in one place. So what happens is a ledger will basically help me in finding out what are my total sales for the year, what are my total purchases for the year, how much furniture do I have, how much property, plant and equipment do I have, so on and so forth. So a ledger is nothing but you collate all the data of different accounts in one place. That's known as a ledger. And from the ledger, what we do is we make a trial balance. So ledger is like, okay, I've got a question. Ledger is a summarization of all. Yeah. So what's a ledger? A ledger is a summarization of all the transactions, but I segregate them and I show them separately. So a ledger would be something like I'll show the sales transaction separately. I'll show my purchase transaction separately, and any other transaction, I'll categorize it and I'll show it separately so that it becomes easy for me to understand what has happened in my company during the year with respect to, let's say, sale, purchase, or whatever be the transaction. And from this, I'll end up making a trial balance. So let's say I've got a total sale of 1 crore during the year, purchase of 50 lakhs during the year. So I'll, in a trial balance, I'll just have something like this: sales 1 crore, purchase 50 lakhs, so on and so forth. So a trial balance is nothing but a balance of all the ledgers. And from the trial balance, you finally make your balance sheet and your profit and loss account. That's the flow of the transactions. You'll have the transactions, then you record them, which is known as a journal. Then finally, you have the ledger, then the trial balance, and then you make a P&L and a balance sheet. Okay, I've got a question. Why can't we directly add the entries in the ledger instead of the journal? No, so I first have a journal and then I have a ledger. Okay, I'll just explain you how it happens. So let's say 1st of April, I sell goods to X worth 10 lakhs. Then there's another party who's come, Y. I've sold goods worth 20 lakhs. So all this is happening in my journal. I'm recording the transactions. Then on 2nd of April, I again have a sale to Z worth 30 lakhs. Then I also have a purchase. Okay. So I record all of them. And then once I've recorded all the transactions, what I do is I make an account and that gets captured in my ledger. So in a ledger, I'll have a sales account. And in the sales account, I'll say, okay, I have sales worth 10 lakhs, 20 lakhs, 30 lakhs. So I have sales worth, let's say, 10 lakhs, 20 lakhs, 30 lakhs. And I'll say, okay, what's the total sale? The total sale for the entire year is, let's say, 60 lakhs. So all the transactions for a particular account get clubbed together and I make different accounts in a ledger. So like, okay, fine. So somebody is saying ledger is like a summary of the account statement. Yeah. So in a ledger, I clearly know what has happened during the year with respect to my sales. Let's say I bought a few computers. So different computers were bought on different dates. So let's say initially I bought a computer worth 50,000. Then I bought a computer worth 1 lakh. Then I bought computer worth 10 lakhs. So put together, I get to know what are the total amount of computers that I have during the year. So I consolidate everything and show it in different accounts in a ledger. And from this ledger, I make a trial balance, and then I use that to make a balance sheet and an income statement or a profit and loss account. Yep. Any doubt with the flow? So transaction, journal, ledger, trial balance, balance sheet, and then your profit and loss account. Now, what tool is used? Companies normally use SAP. So companies would use SAP, where they record the transactions and automatically the, let's say, the journal, the ledger, and the balance sheet and the P&L is made. So it's no more a manual system where you first do it on Excel and then you export it. You just record the transactions, and as and when you record it, automatically everything gets made on its own because it's all automated and systemized. Okay, fine. Now, once we know the basic, then we can move to what's a balance sheet, what's an income statement, and what's a cash flow statement. Now, again, I've got a question saying, is adding entries to a ledger a monthly activity? Leave aside monthly, it could be a daily activity. Because, I mean, look at a company like Tata Motors. A company like Tata Motors will not have just, let's say, one sale in the entire day. They will have, let's say, thousands of sales because they have thousands of dealers across the country. So I'll consolidate and say that, okay, on 1st of April, I've had a total sale of, let's say, 10 crores. I'll have different transactions because I would have sold my cars to different dealers across the country. And for that day itself, I'll have a sale ledger, which will tell me, okay, on 1st of April, how much is the sale? So on a daily basis, the system captures everything, and I'll have a ledger, a balance sheet, and a P&L. Yeah. So segregating the transactions model wise or region wise, again, you don't, in a ledger, you basically don't segregate transactions on the basis of, let's say, region wise. But then maybe in your system, what you will have is, let's say I've got a total sale of, let's say, 1,000 crores. I want to find out how much sale is done in India, how much sale is done in China, and how much sale is done in US. So again, in your system, you could have a process where you say that whenever I'm recording a transaction, I'll mention the sale, where it is happening, in which country it's happening. So accordingly, my ledger will just tell me the sales. So it will tell me that my sales are worth 100 crores. Then again, in that, different companies, if they want to get a bifurcation, they could get a bifurcation where the automated system, the SAP, would help them and would tell them what's the geographical breakup. So the geographical breakup could be, let's say in India, you've got a sale of 60 crores, in China, you've got a sale of 30 crores, and in US, you've got a sale of 10 crores. So the system will help you that. So depending upon what all information you want, accordingly, you'll have to tell your IT department that this is what I want in my SAP system. Okay, I've got a question. What's the difference between a transaction and a journal? A transaction is something which I'm just doing. When I record it, I say that I'm recording it in a journal. So let's say you come to my shop and I sell goods to you worth 100 rupees. That's a transaction, but I need to record it and jot it down somewhere. So where do I do that? I jot it down in a journal. Yeah, so I've got a question. Do I have multiple ledgers? Yes, definitely I have multiple ledgers depending upon what all transactions do I have. So let's say I've purchased raw material. So I could have a raw material ledger. I could have a finished goods ledger. I've sold goods to different parties. I've sold goods to X, Y, and Z. So I could have a ledger for X. I could have a ledger for Y. I could have a ledger for Z. And put together, I could have a ledger which tells me what is the total sale which I've done to X, Y, and Z. So depending upon what type of data you want, you could have different types of accounts over there. Okay, so let's move to, yeah, so for salaries also. So salary is again a transaction. So for salary, again, what I'll do is I'll first record it in the journal, and then from that, I will have a ledger for a salary. So I'll have a salary account. I'll have a salary account, something like this, where I'll keep writing all the salaries that I've paid. And then at the end of the year, I know what's the total salary that I've paid to all my employees. Okay, so now let's move to the financial statements. Now, like I said, financial statement will consist of a balance sheet. Balance sheet shows the financial position of a company. It shows the assets and the liabilities that the company has. and balance sheet is made as on a particular date. So balance sheet would always be, for example, as on 31st March 21. So balance sheet is for a point in time. It's made for a particular date. Okay, I've got a question. Ledger is the summarization of the journals. Ledger is a summarization of the journals for different accounts. So in a journal, I'll have thousands of transactions related to different items. For example, I've paid electricity bill, I've paid telephone bills, I've paid insurance. A ledger, I'll have a separate account for insurance, I'll have a separate account for electricity, I'll have a separate account for salary, so that it becomes easy for me to find out what's the total electric bill that I've paid, what's the total telephone bill that I've paid, so on and so forth. So a balance sheet is made as on a particular date. So let's say if you're following a financial year, which is April to March, you'll make a balance sheet as on 31st of March 21. Similarly, if you're following a calendar year, you end up making a balance sheet as on, let's say, 31st of December 21. So depending upon whether you're following a calendar year or a financial year, you would make a balance sheet. And in a balance sheet, what you show is the assets and the liabilities. Then what you have is a profit and loss account, which is also known as income statement. Income statement will talk about the revenues and the expenses. So balance sheet talks about the assets and the liabilities. Income statement talks about the revenues and the expenses. And this is for the year. So you'll always have something like income statement for the year ending 31st March 21. So income statement is for the period, balance sheet is as on a particular date. Now again, the balance sheet is made once a year. Now see, if a company wants to share the financial information, they'll share the financial information with outsiders, where they'll show the balance sheet as on 31st of March or 31st of December. But as a part of the company, as an employee of the company, as a top management of the company, I have SAP systems in place. And for every day, I will have a balance sheet and a P&L, because every day there are transactions which are happening. Every day that transaction will get captured in the journal and the ledger, and I can know what's my profitability for that day, and I can know what's my financial position, how much assets and liabilities I have as on that particular day. But then if I want to share it with an outside world, I generally just do it for, let's say, the end of the year. So that's my balance sheet, that's my income statement. And then I have the cash flow statement, where I talk about money coming in and going out. Money can come in or go out either because of your operating activities. So that's your day-to-day activity. So let's say I'm selling goods, so the customer will pay me, so the money will come in. I'm buying material, so I'll pay to my supplier, money will go out. So that's like your day-to-day operations. So money can come in or go out because of your day-to-day operations. Money can come in and go out because of investing activities. I'm buying some property, plant, equipment, land, building, so money will go out. I've got a car which has been used for the last 10 years, and I want to just sell it off. So when I sell it, I get some money. So that's money coming in. So that will be a part of investing activity. And finally, what we have is we've got one more, which is a financing activity. So as a company, I could raise money either through shares or loans or bonds or debentures that will get captured in a financing activity. Okay, I've got a question. Does the auditor check the balance sheet of the company? Yes. What is the job of an auditor? The job of an auditor is to do the audit and to state whether the financial statements show a true and fair view or not. If he feels that the financial statements are not showing a true and fair view, then he could come up with a qualified report where he feels that, okay, this particular transaction or this particular, let's say, account, he doesn't agree with what the company is saying. So an auditor will go through your books of accounts and state and express his views on your financial statements. Okay. Now let's look at each one of them in detail. So let's first start with a balance sheet. Now, like I said, balance sheet will consist of the assets and liabilities. So a balance sheet is made in a vertical format where you show the different assets and liabilities one below the other. What you have is shareholders fund. Shareholders fund means any money which belongs to the shareholders. So this could consist of equity share capital. It could consist of preference share capital and would consist of reserves and surplus, which is nothing but the profit that has been generated by the company. Again, we look at what's equity share capital, what's preference share capital, what's reserves and surplus in detail over the next, let's say 5, 10, 15, 20 minutes. So shareholders fund basically talks about the money which belongs to the shareholders. I could have equity shareholders, I could have preference shareholders, and it also captures the profit that has been generated by the company. Then next in line, I will have liabilities. Anyone who can tell me what do you mean by a liability? Okay, so you're giving me an example, which is loan to whom I should pay. Fine. So liability is nothing but a financial obligation that the company has towards an outsider. So for example, I've taken a loan from SBI or HDFC or ICICI Bank. So I'm supposed to pay it to a third party. I've bought raw material from my supplier. I have to pay the money to my supplier. So that's again a liability for me. So I'll have shareholders funds, I'll have liabilities, which are nothing but commitments or obligations that I have, and I need to pay them to the outsiders. Liabilities could be of two types. You could have non-current liability, or you could have a current liability. Now, what's a non-current liability or a current liability? Anyone who knows the difference between a non-current liability and a current liability? Okay. So a non-current liability is a liability where you're supposed to make a payment to someone after 1 year. So let's say I've taken a loan and I have to pay that loan after 2 years or 3 years, then it becomes a non-current liability. But current liability is something which I'm supposed to pay to someone within 1 year. I've bought raw material from you. You give me a period of, let's say, 3 months to make that payment. So I have to make a payment within 1 year. Then in that case, I'll say it's a current liability. Salaries. Salaries I don't pay to my employees after 1 year or after 2 years. So let's say the salary for the month of October would be paid in the later part of October, or maybe max to max, let's say in the first week of November. So again, that is something which I need to pay to my employees within 1 year. So that again becomes a current liability. So non-current liability, payment is to be done after 1 year. Current liability, payment is done within 1 year. Then you also have the assets. So let's assume that my shareholders funds put together over here is, let's say, 1,000 crores. Let's say the total of the liabilities is 2,000 crores, which means the total becomes 3,000 crores. Now, once this is done, then I'll also have the assets. Assets again will be of two types. I can have non-current assets and current assets. Now, what are non-current assets and current assets? Non-current assets are assets which are basically held for long-term use. You do not buy them with an intention to sell them or consume them. For example, I have a factory building. I didn't construct that factory with the intention to sell that building. No, I've made that factory so that I can produce goods. Similarly, I bought some machine. I will use that machine over the next 15, 20, 30 years to produce goods. So that's a non-current asset. So a non-current asset is held for long term, used for producing goods with no intention of selling it in the near future. Furniture fixture is again an example of your non-current asset. Current asset, on the contrary, is something which is generally consumed within 1 year, and it keeps changing the form. For example, I come to your factory and I buy some raw material. That raw material, I'll process it and I'll make a finished product. That finished product, I'll sell it to my customer, and the customer will finally give me money. So I'll get cash. So current asset is something which will get consumed within 1 year, or it will keep changing form. So raw material will get converted to finished goods. Finished goods will get converted into clients or customers, which are known as debtors. And then from debtors, I'll receive cash. So that's your non-current asset and current asset. A balance sheet should always balance, which means the total of the shareholders fund and liability, which is 3,000 crores, should be the total of the assets, which will also be 3,000 crores. Any doubt with the basic of the balance sheet before we deep dive into each line item, such as share capital, reserves and surplus, non-current, current, non-current, and current? So I've just given you an overview of a balance sheet without getting into the details and the nitty-gritties. Any doubt with this, anyone? Now, NPA will typically happen in case of a bank. So when a bank, let's say, it gives a loan to someone and it will wait for 90 days and then the person starts defaulting, then I start treating it as a non-performing asset. So in that case, the banker starts making a provision. So what will happen is, let's say a banker has given a loan of 100 crores and the person has repaid only 80 crores, but for the remaining 20 crores, he's not doing the repayment for the last 90 days. So I, as a banker, will start making provisions, and I'll create a provision saying that there is a possibility that this person may default and may not pay in future. Yeah, Gaurav, you've raised your hand. Yes, Gaurav, you want to say something? Okay, I'll just move forward till the time I get text from Gaurav, and then we'll see if he has any specific doubt or not. Okay. Then just like we have a balance sheet, we'll also have an income statement, which is also known as, let's say, a profit and loss account. So in an income statement, basically what you have is you've got your revenues, you've got your expenses, and finally, you tell me whether you've made a profit or a loss. Okay. No, as far as NPA is concerned, I explained that, right? I said that, okay, the banker has given a loan of, let's say, 100 crores. Out of 100 crores, the banker has received 80 crores, 20 is still pending. So I will still show this 20 crores as an asset because I've given a loan to you. But then I start creating a provision. So in my income statement, which we'll discuss now, which is the profit and loss account, what I do is I start creating a provision, and I'll say, okay, depending upon what's the feedback that I'm getting, depending upon the market situation, I'll make a provision either for entire 20 crores because I feel that you will not pay me entire 20 crores, or maybe I feel that no, maybe you'll be in a position to pay me 5 crores or 10 crores. So I'll create a provision for the remaining 5 or 10 crores which will not pay me. So accordingly, that's how bankers will capture the NPA, which is non-performing asset. And of course, they'll take legal measures. They'll start sending you legal notices, and finally, maybe you'll be dragged to court. Okay. Now let's look at an income statement. An income statement will basically talk about the revenues that you're generating. So maybe let's say I've got sales of 5,000 crores and I've got some other income. Maybe I've done some investment, so I'm getting some income from that. So I've done some investment, I've put some money in an FD or something, I'm getting interest income, I'm getting dividend income. So I'll capture that. And let's say the total revenue is 5,000 crores. I'll also capture my expenses. So my expenses could be in terms of salary, it could be in terms of material, it could be in terms of electricity bills, so on and so forth. Let's say that's 3,000 crores. Finally, I'll say I've made a profit of 2,000 crores. So I'll have revenues, I'll have expenses, and finally I'll have my profit and loss. So what's the revenue? Revenue is nothing but the income which the company is generating when they produce and sell those goods or when they render the services. For example, let's say TCS is a software company. They'll make software and sell it to different clients. So let's say TCS is giving or making a software for Citibank. So when they provide that service and they give that software, Citibank will give them money. So that will be shown as a revenue for TCS. The expenses which are incurred for making that software, so the salary expense, the rent that I'm paying for my office, all of that will be a part of expense. And finally, TCS will show what's the profit or loss for the company. So any doubt with the basic overview of revenue and expense? Again, we've not looked into different revenues, different expenses, but a general idea of what's an income statement. You'll take your income, reduce your expense, and you'll get your profit or loss. And finally, you have the third statement, which is a cash flow statement. So like I said, a cash flow statement, I'll show the cash that is coming in or going out from my operating activities. That's my day-to-day operations. So let's say that's 500 crores. I will show the money coming in and going out because of financing activities. So maybe I've taken some loan, I've repaid loan, I've issued shares, I've done a buyback of shares. So all of that will come over here. Again, let's say that's 1,000 crores. And then I have something which is like an investing activity where I bought some asset and maybe that's 200 crores. So I'll say, okay, what's the total cash and cash equivalent generated during the year? 1,300 crores. So this will all be a part of the cash flow statement. Okay, I've got a question saying that a loan that we take is a part of revenue. No. When you take a loan, tell me, is it an income that you've generated? No, it's not an income that you've generated. Loan is a liability. So that will be a part of my balance sheet. I'll show it over here. And the interest that you will be paying on the loan will be an expense. So that will come in your income statement. So loan will go to my balance sheet in the liability. The interest that I have to pay to the banker, let's say every month or every quarter, I will show it as an expense in my income statement. Cash flows will record money coming in and money going out. There's a difference between, let's say, expense and income and cash. For example, I've got an expense like depreciation. Now, again, I don't know how many of you know it, but what is depreciation? I was supposed to cover it, let's say, over the next 5-10 minutes. I buy an asset. So let's say I buy a computer or a laptop. And I start using that laptop over the next 4-5 years. So if I use that laptop or a computer over the next 4-5 years, the value of that asset will go down. So let's say I bought that laptop for 60,000. After 1 year, if I go and sell it, I will not get 60,000. Maybe somebody would be ready to pay me 30, 35, 40,000. So this reduction in value of an asset is known as depreciation. Now, depreciation is an expense for me. I will show it in my income statement or the profit and loss account. But depreciation is a non-cash expense. You've already paid for that laptop when you bought it. When you reduce the value of that laptop from 60,000 to 40,000, there's no additional cash which is going out of your pocket. So depreciation will get recorded in my profit and loss account, but because it's a non-cash expense, I will not show it in my cash flow statement. Okay, I've got a question. What's the difference between financing and investing activities? Okay, I'll repeat it again. Now, what's a financing activity? Again, let's look at it from, from an individual perspective. I want to buy a flat. I want to buy a house in a city like Bombay. I have my own funds. So let's say I want to buy a flat worth 2 crores. So So I'll have some of my own money and I'll go to a bank and I'll take a loan. This is nothing but finance. How am I running the company? From where am I getting the money to run the company? Either it's my own money or someone else has given me the money. So that is your financing part. Similarly, if you look at investing part, investing is, let's say I buy a car. So that's an investment that I've done. I buy machines. That's an investment that I've done. I buy furniture. That's an investment that I've done. I buy computers. That's an investment that I've done. So investment activities basically deal with the assets that you're purchasing with the money that you have. Financing aspects deals with the sources from which you are getting that money. Okay. Fine. Now let's move into the details of a balance sheet. Now, in a balance sheet, I'll have share capital. And this share capital, I said, could be either equity share capital or it could be preference share capital. And I'll also have reserves and surplus. Now, equity share capital is the money which is pumped in by the equity shareholder. He's the owner of the company. For example, I have a company like Reliance Industries. Reliance Industries has issued shares and you subscribe to those shares. And for each share that you have a voting right. So you actively participate in the decisions which are taken by the company and you are the owner of the company. So let's say let's assume hypothetically that Reliance has, let's assume that it has 10 lakh shares. And out of 10 lakh shares, you got 1 lakh share, which means you have a 10% holding in that company. So equity shareholders are nothing but those people who are the owners of the company. Preference shareholders do not have voting rights. But then why do I call them preference? Because they get preference over the equity shareholders. Anyone who can tell me what preference do preference shareholders get over equity shareholders? And that's why we call them preference. In terms of repayment, fine. So to equity shareholders, I'll give equity dividend. To preference shareholders, I'll give preference dividend. If a company wants to give a dividend to the shareholder, the dividend first has to be paid to the preference shareholder and only then can I pay to the equity shareholder. Okay. Similarly, if the company is getting liquidated, so let's say the company has gone bankrupt, I appoint a liquidator. The liquidator is selling off the assets and whatever money is coming in from the sale of that asset, that will be used to pay off the loans and the liabilities. And finally, if some money is left, that will be given to the shareholders. Even in that case, first the money would be given to the preference shareholders. And if something is still left, it's only then that the money is given to the equity shareholder. Okay, so preference shareholder has preference over the equity shareholder in terms of dividend. And in case of bankruptcy, they'll first get paid, then the equity shareholders will get paid. Okay, I've got a question. Is preference share capital the same as DVRs? No. Preference share capital is not the same as a DVR. DVR is differential voting rights. Just give me 2 minutes. We'll discuss what's a differential voting right. How can I become a preference shareholder? Depending upon whether the company is issuing preference shares or not. Globally, very few companies issue preference shares. For example, if I'm not wrong, JSW has, Jindal Steels has preference shares. So they'll have equity shares, they'll also have preference shares. So let's say just globally 1 to 2% of the companies issue preference shares. Otherwise, most of the companies will only have equity shares. They'll not have preference shares. Now, okay, I've got a question. Why is it that preference shareholders don't have voting rights? Now, as a preference shareholder, I'm not concerned with the day-to-day activities, how you're managing your company. So I'm doing an investment in your company because I just want a return in terms of the dividend. But when I do an investment like an equity shareholder and I'm buying an equity shares, I'm involved in the day-to-day activity, how the company is being managed, how the company is being run. So that's the difference, the intention. Equity shareholder, I want to look at how the company is being managed. Preference shareholder, I'm doing the investment, give me the return, I'm happy. Yeah, okay, I've got a question. Will we have a break? Yep, don't mind, we'll have a break. So let's say around 11:40, 11:45, we'll have a 5-10 minute break. Okay, so we're done with equity share capital, preference share capital. Somebody asked a question on DVRs, which are differential voting rights. Now, what are differential voting rights? Let's look at an Indian example, Tata Motors. Somebody who has a demat account and who's trading and who's buying and selling shares will have an idea that Tata Motors has two classes of shares. One is Tata Motor shares and one is Tata Motor DVR, differential voting rights. Now, what's the difference between them? Now, normally when companies have different classes of shares, one class of share will generally give you more voting rights compared to the other class of shares. So let's assume hypothetically that this is A class share and this is B class share. A class share of Tata Motors will say that one share is equal to one voting right. But the B class share, which is your differential voting right, will say that for 10 shares, you will get one voting right. Now, the question is, if I have less voting rights, why would anyone subscribe to that DVR? Because I get incentivized by getting additional dividend. So if the company has a policy of giving a dividend of, let's say, 10 rupees for A class share, the company could say that any person who has a DVR will get 20% or 25% more than the dividend which is paid to the A class share. So as a shareholder, I'm holding B class shares. I will not get 10 rupees of dividend. Maybe I'll get 12.5 rupees or 13 rupees or 14 rupees of dividend. So again, a differential, a person who has a DVR, he's not too much interested in the voting rights and the day-to-day activities of the management. He's more interested in getting returns. The person who has the A class shares, he's the one who wants to actively participate in the activities of the company. Okay, I've got a question. How is voting carried out? Now, initially, let's say again, if I go back 20, 30, 40 years, what used to happen is you would get physical forms. These physical forms would have to be filled in by the shareholder. So let's say I'm the shareholder and they are taking a decision that they want to expand and they want to set up a new company and they want the shareholders to approve it. So as a shareholder, they would send me the physical form, I would fill it and I would send it to them. And then accordingly, they would decide how many people are in favor of it and how many people are against it. And accordingly, the decision would be taken whether to go ahead with the factory or not. Now with internet coming in and everything, now you don't have physical forms. What you get is basically on your email, you get a form saying that this is what the board has decided. They want to take a decision whether they should go ahead and set up a second factory or a third factory. As a shareholder, this is a form that you need to fill and you need to send it saying whether you are ready and you want the management to go ahead with the setting of the factory or you are against it. So that is what you do. So that's basically nothing but your e-voting, which basically happens. So initially it was not e-voting, it was physical forms which were sent. Now it's all about e-voting and it's all online. Okay, so that's your DVR. So DVR is nothing but differential voting rights, where you have different classes of shares. And this is not only in India, it is applicable globally. Look at a company like Google. Google has three classes of shares: A class, B class, C class. A class and C class is held by normal people like you and me. B class is held by the promoters and the other top management. So Page and Brin have B class shares. The difference is A class shares, one share will give me one voting right. but B class shares, one share will give me more voting rights. So let's assume hypothetically 10 voting rights. So whenever you have a company which has differential voting rights, be prepared that the voting power is skewed towards the top management and the promoters, because they would be the ones who would keep that class of share which has more voting rights, so that they can take the decisions and run the company. Look at Ford Motors. Ford Motors again has differential voting rights. So for example, the Ford family, if you look at it, they have like only 10 to 15% of the shares, but it gives them voting rights to the extent of like 40%. Look at Facebook. Mark Zuckerberg, the same thing. He will have, let's say, 10 to 15% of the shares, but he's got voting rights of like 40, 50%. Okay. So that's nothing but a differential voting right. Now, I've got a question saying, does differential voting right hold true for a single type of shares? Now, if I've got a single type of share, I can't have differential voting rights. So differential voting rights, which means I'll need to have different types of shares. So I'll have A class and B class shares, where I'll say, okay, A class shares will have more voting rights, B class shares will have less voting rights, or vice versa. So again, okay, next question is, what factors will drive the type of shares to be issued by the company? So again, depending upon the management, if the management wants to retain the control and they want majority of the control to be with them, then either they will have DVRs, where they'll have those class of shares which have more voting rights, or if they have only one class of shares, so they have only A class shares, then what they'll try to do is they will have most of the A class shares, and the retail investors like you and me will have less of A class shares. So maybe the management will have, let's say, 60% of A class shares, remaining 40% will be with you, me, financial institutions, lenders, bankers, so on and so forth. So again, that's how the management will try and play around with it. Okay. So you have equity shares, you got preference shares, and finally we said we have reserves and surplus. Now, what do you mean by reserves and surplus? Okay, I've got a question saying that the shares held by the company, employees of the company, what does it come under? Now, when the shares are held by the employees of the company, that's basically an ESOP, which is employee stock option plan. So, for example, all this came into existence globally somewhere in the late 80s and the early 90s, when the tech companies basically started giving ESOPs to retain the top management. So what they do is, let's say I'm the MD or the CEO of the company. So what they'll do is they will start giving me ESOPs, and they'll say, okay, let's say the current market price is 1,000 rupees for the share. You have a right to buy this share for, let's say, 400 rupees. So I can buy this share for 400 when it is currently trading for 600. Now, this is like an incentive for the top management, because the top management would like to strive and work harder so that the market price goes up. So they would like the company to do well in future so that the price goes up. Because if the price goes up from 1,000 to 2,000, then what will happen? I will buy the shares for 400, but I can sell the shares in the stock market for 2,000 and I can make a profit of 1,600. So when the company wants to retain the top management, that's when they basically give you ESOPs. Okay, next question that I've got is, what type of shares the board members have? Do they have voting rights? Generally, of course, the board members will have voting rights. Otherwise, there's no point in becoming a board member if you don't have a voting right, because then it's just like going over there, giving your opinion without having some substance and some backing. So you need those voting rights so that you can say that, okay, I've got 10% voting rights. This is what I want the company to do. Otherwise, nobody would listen to you. Okay, so let's look at reserves and surplus. Let's say the company has made a profit of 1,000 crores. Now, what does the company do with this profit of 1,000 crores? The company would give dividends. So let's say the company has given a dividend of 600 crores. Remaining is retained by the company. So 400 is retained by the company. So the company will generate profit, give dividends, be it equity dividends or preference dividend, and whatever surplus is there, that is retained by the company. Again, it belongs to the shareholders only, because entire profit of 1,000 crore belongs to the shareholders, out of which I've already given 600 to the shareholders. Remaining 400 also belongs to them, but I'm just retaining it. So it's like I'm holding someone else's money. I'm keeping your money, but at the end of the day, it's your money only. So when I'm looking at shareholders fund will consist of equity share capital, will consist of preference share capital, and will consist of reserves and surplus, because it's their profit which they're entitled to, but I've just retained it and kept it on their behalf. Okay. Now let's look at the non-current liabilities and the current liabilities. Okay, I've got a question. When we say shareholders will get money, does it mean that the stock value will go up? No, shareholders will get money in terms of what? When they sell it, you're asking me in terms of that, or what? Or you're talking about ESOP? Yeah, Priyansh, if you could just tell me. Profit distribution, fine. Now, profit distribution. So again, let's go back to this example. The company has made a profit of 100,000 crores. At the end of the day, I can't, let's say, go and buy grocery from a mom and pop store saying that I'm a shareholder in Reliance Industries. Reliance has made a profit of this much, so give me the grocery. No, the grocery store will need money. So I will need money. The shareholder will get dividend in terms of money. So out of 1,000 crores, when I'm saying that the company is giving a dividend of 600 crores, this will be paid in cash. So money will get transferred into your account, bank account. You will actually get that money in your bank account. If you are a equity shareholder, you'll get that dividend. Okay. Now, so we had shareholders fund, and then we had liabilities. And under liabilities, we said we'll have non-current liabilities and we'll have current liabilities. Okay, I've got a next question. Generally, when the share price goes up, people tend to sell them. Then how price goes up for a share? Now, if I am a great company, if I'm taking up good projects, I'm delivering what the client wants, and I'm fulfilling the expectation of the shareholders, then my share price will go up. So let's say I, as a shareholder, need some money. So the share price went up from 400 to 2,000. I sell the shares. Some other people will sell the shares. Now, just because I'm selling the shares, there'll be some other person who's buying also, right? So some other person will buy because he feels that the share price will go from 2,000 to 3,000, because it's a great company. They've got great projects in future. They'll do well in future also. So this demand and supply and how the company is being fundamentally run will drive the price. Okay. Let's move back to the liabilities. Let's look at non-current and current, and then we'll take a break. Now, non-current liabilities, as we discussed, is a long-term liability which is supposed to pay after 1 year. So examples over here would be, let's say I've taken a long-term loan. So I've taken if I look at an individual, maybe I've taken a housing loan, which is like a 20-year loan. So it's a long-term loan because I have to repay it over the next 20 years. So a long-term loan would be, let's say, an example of a non-current liability. Then look at, let's say, gratuity provision for a company. Now, gratuity is to be paid by a company to any employee who leaves after 5 years. Similarly, let's say pension benefits. Pension benefits are to be given if that employee retires. So again, this is a long-term liability, because let's say today that employee is just 30 years old. He will retire at the age of 60. So you will have to pay him pension after 30 years. So that's again a non-current or a long-term liability for you. So these are basic examples of non-current liabilities. Similarly, if you look at current liabilities, so current liabilities are liabilities which are supposed to pay within 1 year. So again, maybe I've taken a short-term loan. So I've taken a personal loan which I have to repay within the next 3 months or 6 months. I've taken a loan on my credit card which I'll repay over the next 1 month or 2 months. So that's a short-term loan. I've bought material from you. If I buy material from you, maybe you give me a credit period of 1 month, 2 months, and I have to make a payment after 1 month, 2 months. So that again will be a part of current liability. So creditors are nothing but your suppliers. So suppliers, In finance, we call them as creditors. And I could have other current liabilities and provisions. So maybe electricity bills that I have to pay, gas bills that I have to pay, water bills that I have to pay, taxes that I have to pay. All of that has to be repaid within 1 year, and therefore we call them as current liabilities. Any doubt with the shareholders fund and the liability? Otherwise, we take a break. Okay, so let's take a break. It's 11:40. Let's resume at 11:50, and then we move to the asset side of the balance sheet, and then we move to the income statement. So let's resume at 11:40. Sorry, 11:50. My bad. Let's resume at 11:50. Okay, let's resume. Let's look at the asset side of the balance sheet. Now, if I look at the asset side of the balance sheet, I basically have two types of assets: non-current asset and a current asset. Again, non-current asset, like we discussed, is something which you buy for holding it for a long term with no intention of selling it in the near future. Current asset, you'll end up consuming it or you end up selling it in the near future, which is within 1 year. Non-current assets will have either tangible assets or they will have intangible assets. So under tangible assets, you'll get things like property, plant, equipment, machinery. So anything which you can touch, feel, and see, you say it's a tangible non-current asset. Something which you cannot touch, feel, and see, you categorize and say that it's a intangible non-current asset. So like I said, tangibles would consist of property, plant, equipment, furniture, fixture, maybe some land that you have, maybe some computers or whatever. So that's your tangible asset. Intangible asset, something which you cannot touch, feel, and see. For example, goodwill, patents, trademarks, know-how, brand. All of this will be your intangible asset. So non-current asset consists of tangible and intangible. As in when you use that asset, the value goes down. And when the value goes down, that reduction in value, if it is for a tangible asset, we call it depreciation. But if that same reduction in value is for an intangible asset, we don't call it depreciation, we call it amortization. So it's the reduction in the value, but if it's for tangible, we call it depreciation. If it's for an intangible, what we do is we call it as an amortization. If you look at the current assets, like I said, something which you consume within 1 year or they'll change form. So current assets would be something like a raw material. I'll buy the raw material, then it will get converted into WIP, which is work in progress. So it's neither a raw material nor a finished product. Then it will consist of, let's say, finished goods. I'll sell the finished goods to my clients, my customers, which I call them as debtors. Debtors will give me cash. So all these are different examples of a current asset. I've paid insurance in advance, I've paid rent in advance. That's again an example of a current asset. So prepaid expense will also be a part of current asset. So any doubt with the assets, which is your non-current and your current asset? Otherwise, we look at a small caselet. Yep. Okay, so fine. Okay, I've got a question. Explain again which part, Shubhil, you want me to explain? Current asset and non-current asset. Okay. So current asset is something which you end up consuming within a short span of time, or it changes its form from one to the other. Raw material will get converted to WIP, WIP to finished goods to your clients will give you the money. So the form keeps changing, or you end up consuming it, and you do that within 1 year, then it's a current asset. Non-current asset is something which you hold for a longer period. You have no intentions of selling it in the near future. For example, as a company, I set up my factory. I've got no intentions of selling it in the next 6 months. So that's a non-current asset. I buy machines. I have no intention of selling it in the future. That's a non-current asset. Okay. Now let's take an example. How many of you have heard about a company named Gujarat Ambuja? Okay. So if you look at this company, Gujarat Ambuja, it's into cement business. Okay. Now they've been into cement business for decades. Ambuja Cements. Yeah. Now Let's take a hypothetical example. It's not a real life example, but I just gave you an example of Ambuja Cements. Let's say you are a part of the top management, maybe the CEO, maybe an MD or whatever, and the company is taking a decision. The decision is they've got 3 projects: Project A, Project B, and Project C. Project A is a brownfield project. Project B and C are greenfield projects. Anyone who can first tell me what's the difference between a brownfield project and a greenfield project, if you know it? Okay, fine. So I've got an answer like expansion versus new, greenfield is from the scratch. Fine. Now, what's a brownfield project? A brownfield project is where you already have the infrastructure, you're just expanding it. So, for example, let's say if Gujarat Ambuja already has a 5 million ton cement plant, they want to expand it from 5 million ton to an 8 million ton in the same place, same location. So, infrastructure is there, everything is there. I just need to get some additional machines and then start producing more. That's a brownfield project. What's a greenfield project? I start from the scratch. I go to a new place and I set up my cement factory from the scratch. That's a greenfield project. So greenfield is when you start from the scratch. Brownfield is existing infrastructure is there. I just want to expand it. So they have 3 projects. A is a brownfield project. For example, let's say a 3 million ton plant has to be expanded to a 5 million ton plant. So they just want to expand it in the same location. Okay, I've got one more answer. Brown is adding on the existing capacity. Yeah, existing capacity in the same place. Existing capacity, if it's in a new place, then it will become a greenfield. Then let's say project B, I want to move into cement business only. But let's say currently I'm operating, let's say in the western part of the country. So project A is when I'm operating in the western part of the country. B is when I move to the eastern part of the country. Maybe I move to places like Jharkhand, Bihar, or Bengal, and I want to set up a 2 million ton plant. So over here, I'm expanding from 3 million to 5 million ton, which is a 2 million ton expansion, but it's in the same place. So it's a brownfield. Greenfield, I move to another location. I start from the scratch and I set up a 2 million ton plant. So, but it's in the cement business. Third is I want to move into textile business and I want to set up a factory somewhere in the north, maybe Punjab, Delhi, Haryana, somewhere out there. Okay, so this, let's name this company as Gujarat Ambuja Hot Spin. Okay, and this is Gujarat Ambuja New Cements because it's a new company that they'll set up. So 3 projects, 2 into cement, 1 into a new sector which is textile. Even in cement, one is a brownfield, another one is a greenfield. Now, we know that companies can raise money either through shares or by taking a loan or issuing bonds or debentures. So there are 2 things. Either you raise money through equity or you raise money through debt, which means you're liable to pay someone. Now, how does a company decide whether they should raise money through issue of shares or they should raise money by taking debt? There are basically 3 things which come into place, along with definitely other factors, but 3 things that are basically looked into is availability, flexibility, and cost. So you look at whether that source of financing is available or not. So that's availability. You will look at flexibility. What do you mean by flexibility? Can I use that money the way I want? Or someone is standing on my head and telling me, no, this money can be used for only this purpose, otherwise don't touch it. Cost, is that source expensive or cheap? Let's look at the first one, availability. And let's take examples. Look at the early 90s, before the Harshad Mehta scam came out. Harshad Mehta was the one who gave the Indians a flavor of the equity markets. He was the one who said you can invest in equity markets and make a lot of money. So that was the time when a lot of people started investing in equity markets and companies were having a tough time to raise money by issuing bonds or debentures. So for example, a company like Tata Steel was finding it difficult to raise money worth, let's say, 1,000 crores by issuing bonds or debentures, because nobody wanted to get into a debt instrument. Everyone wanted to move only into equity markets. So if nobody wants to buy your bonds or debentures, you will have no other option but to either cancel that issuance or maybe postpone it. And once things change, then maybe issue a bond or a debenture. So availability is that source of financing available at that point in time? If it's not available, either I postpone it or I move to another source. Flexibility, like I said, it says whether I can use the money the way I want. Now, keeping this in mind, can you tell me whether shares, if I'm issuing equity shares, they are more flexible or debt is more flexible? Flexibility means I can use the money the way I want. Debt is more flexible. Okay, I've got answers like debt, debt, debt. Okay, let's take an example. You go and take a home loan. That's a debt because you've taken a loan. Can I use this money to buy car? Can I use this money to buy computers? Can I use this money to go on a foreign trip? No. Debt is much more restrictive because when you go and take a loan, the agreement will clearly say that this money can be used for only this purpose. Otherwise, don't touch the money. Except for maybe if you're taking a personal loan where you can use it the way you want. Otherwise, if it's a car loan, I have to use it for car. I can't just divert the funds and buy my furniture. So if I, as a company, I'm taking 1,000 crore loan for expanding my factory, I can't use that money for buying a charter plane for me. It has to be used for expansion of the factory because there will be covenants which will be inserted in the agreement which clearly restrict and tell me this money can be used for only this purpose. I'll give you an example. If you look at, let's say, a few years back, ICICI Bank, if you look at their annual report, they had multilateral lines of credit which they had received from Scandinavian banks. Now, what these banks did is they gave some money and they said, okay, let's assume hypothetically they gave 10 million euros. And they said to ICICI Bank, this money can be used by ICICI Bank and you can lend this money. So you can give this money as a loan to any person you want. But then that person, so if you're lending this money to XYZ, then XYZ should use this money to buy equipments which are made by Scandinavian companies. If not, then don't touch this money. So ICICI Bank had multilateral lines of credit from Scandinavian banks. Condition was touch this money, give it as a loan to another person who will use that money to buy equipments made by Scandinavian companies. Otherwise, don't touch this money. So debt is much more restrictive compared to shares. Fine. Okay, I've got a question, but the bank will not tell me what type of house to buy or which part of the city to buy. Whereas in shares, any shareholder can apply and all the delay decisions. Fine. Banks will not tell you where to buy and what to buy. But when you apply for a home loan, you have to clearly tell the bank that this is the house that I'm buying. This is the house which will be given as a collateral. I just cannot give an application to a bank. I'm interested in buying a house anywhere in India. Please sanction a loan worth 2 crores. No, the bank will not do that. So banks will clearly say, okay, which house you want, show me the papers, show me the documents. They will do their own verification and accordingly decide whether the loan needs to be sanctioned or not. But as far as equity is concerned, it's far more flexible. For example, let's say the company comes with an IPO, initial public offer, when they're raising the money for the first time. And they tell the shareholders, we want to raise 10,000 crores because we want to build a factory which is, let's say, into textile business. And the details will clearly mention, the details will clearly say how much will be the land cost, how much will be the factory cost, how much will be the machine cost, so on and so forth. So let's say land cost out of 1,000 is 500 crores. The factory that you're building is, let's say, 200 crores. And the machines that you're getting is 300 crores. Put together 1,000 crores. As a shareholder, I take those shares and I give the money to the company. Now the company is supposed to use these 1,000 crores in this proportion, which is 500, 200, 300. But as long as there's not too much of a deviation, I will not get into the nitty-gritties and say, okay, why is it that the land cost has become 502 crores and the factory cost has gone down to 198 crores? If there is more or less consistency in their expense, I'm fine with that. So equity shareholders are still much more flexible compared to the lenders. Lenders are very rigid. They will not let you use the money the way you want. Okay, I've got a question. How does existing investor gain from an IPO of a company? Now, as an existing shareholder, how do I gain from an IPO of a company? Again, I don't want to get into the IPO of Mica and Zomato, but then let's take an example. Let's say I am an investor, X. I have invested in a company Y. And I invested in this company when this company was a startup. Slowly and steadily, this company has become a big company. This company is doing well. Now, when I invest money in a company, then I always invest in a company with a time horizon of, let's say, 5 years, 6 years, 3 years, 10 years. And after that, I want to sell the shares and I want to move out. How do I sell my shares? For this, what I'll do is I'll tell Y to get listed and come with an IPO. So Y gets listed, it comes with an IPO, and that is when X will sell the shares and someone else will buy the shares. So that is how you make money in an IPO. Okay. So we were looking at availability, flexibility, and then let's look at cost. Now, cost means which is more expensive. Which one do you think is more expensive as a source of financing for the company? Do you think equity is more expensive for a company or debt is more expensive for a company? Okay, I've got answers which are mixed. Some people are saying it's debt. Some people are saying it's equity. The correct answer is equity is much more expensive. Debt is cheap. Why? Again, let's understand the logic rather than just mugging it up. Why equity is expensive and debt is cheap. Now, let's say I'm a company like Reliance Industries. I can issue shares and I can take a loan. When I take a loan, I generally give an asset as a collateral. So the banker gets some sort of a security. Okay. The banker will charge me an interest rate, which is, let's say, 10%, 12%, depending upon what is the credit rating for the company, what are the interest rates which are currently going on in the market, and accordingly, the banker will charge me. Let's assume hypothetically it's 10%. If I default, the banker has a backup. He can sell that asset and recover the money. Okay. So the risk for the banker is less. And therefore, his expectation is 10%. Compare that to an equity shareholder. I am an equity shareholder of Reliance. When will I get the money? Only after paying the debt, only after paying money to the preference shareholder, then I get my equity dividend. If the company is going for liquidation, I'll first pay off all the liabilities, then I pay money to the preference shareholders. If something is left, I will get it. So I'm like the person who's standing last in queue. I'm the beggar and saying, please, if something is left, give it to me. Which means I'm the one who's bearing the maximum risk as an equity shareholder. And if I'm bearing a maximum risk, my expectation will also be more. So equity shareholders, because they bear a maximum risk, the highest risk, their expectation is more. They will not expect 10%, but they will expect more than 10%. Take a simple example. You have 10,000 rupees. You have two options: invest it in an FD, which is a fixed deposit in a bank, or invest it in stock markets. FD is giving you a return of, let's say, 5%. I tell you, markets are also giving 5%. Where will you invest the money? In FD or stock? FD, because FD has less risk. So lower the risk, lower is the expectation, higher the risk, higher the expectation. Now, if I tell you, no, if you invest in markets, markets will give you 10%. Now there'll be people who will say, no, I'm a person who's ready to take more risk because I'll be getting more returns. I can invest money in equity markets. There'll be someone who's risk averse. He'll say, no, 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 I'm not concerned with 10%, 12%, 15%. I want consistent guaranteed returns. I want to put my money in an FD because I'm a risk averse person. So higher the risk, higher the expectation, lower the risk, lower the expectation. So going by this logic, if I look at flexibility, equity is more flexible than debt. But if I go ahead with cost, equity is more expensive than debt. Okay, I've got a question, but marketing in mutual fund is always giving high returns, so it's not risky. Again, what is a mutual fund? Mutual fund is nothing but a pool of money which is getting invested not in one stock or one company, but it's getting spread. So you get a diversified risk. So let's say if out of 30 companies where the mutual fund is investing, 5 don't do well, remaining companies do well, the risk gets mitigated. So that is what is happening in a mutual fund. So rather than investing your entire money in one company, you invest money in different companies, which a mutual fund is doing. Okay, fine. So as a company, what do you want? You would want the best thing. So you would want to go ahead with something which is cheap, which means you want debt. But at the same time, debt is not flexible. So you want debt because debt is cheap, but debt is not flexible. You want to go ahead with equity because equity is flexible, but it is expensive. So this is where a problem of choice arises, and the companies have to choose between debt and equity depending upon the circumstance and the situation. Again, if we go back to that example, now when you know the meaning of flexibility and cost, and let us assume that both the options are available. Gujarat Ambuja can go ahead and take a loan. Gujarat Ambuja can issue shares. So there's no problem. So it's not that one source is available, other is not available. No, both sources are available, equity and debt. In project A, would they focus more on flexibility or cost? In project B, would they focus more on flexibility or cost? In project C, would they focus more on flexibility or cost? So whether in project A, they'll raise money through debt or equity. Similarly, in B, whether it's debt equity, or in C, it's debt or equity. Okay, I've got an answer saying A will be debt. Okay. A, it's a brownfield project. I've been eating, drinking cement for decades and decades, and I'm doing an expansion in the same place. I know things in and out. I know my customer base. I know the tax policies of the government. I know from where I need to get the machines. Everything is in place. The risk is less. So I'll focus more not on flexibility, but I'll focus more on cost. And over here, I'll prefer to raise money through debt. Okay. Compare that to C. C is a greenfield project. I have no idea about the textile business. I've had a consultant, maybe a McKinsey or an Accenture, and they have given me a proposal that I should move into textile business. I'm totally dependent upon what the consultant has told me. There's too much of risk. And if there's risk, I would like that flexibility, because I don't know whether that land cost will be 500 crores or whether it will be 600 crores. I don't know whether the machine would be 500 crores or whether it could be 480 or it could be 520. So I want that flexibility. So if I want that flexibility over here, I would focus more on equity. So majority of the funding for A would be through debt. Majority of the funding for C would be through equity. And for B, it'll be a mix. So because it's like a balance. So I'm moving to a new location, but it's in the same business. So it's the cement business. I clearly know from where I can get the machine. But a few strange things can happen. I don't know the customer base. I don't know the customer preference. I'm not that comfortable with the government norms, rules, regulations, taxation policies in the eastern part of the country. So government could have separate state tax laws. So a few new things can happen. So in B, I will raise money through a mix of both debt and equity. In A, focus will be more on debt. So maybe let's say 80% of the money could be through debt, remaining 20% could be through equity. C, vice versa, 80% through equity, remaining 20% through debt. For B, it will be like a mix, maybe 40 to 50% through equity and 40 to 50% through debt. So this is what companies in real life will do when they have to take a decision whether to raise money through debt or equity. And this is very simplistic. In real life, things will not be that simple. You'll have 10 other factors, and we'll have to look at all those factors put together and then decide what source of funding should be used. Yeah, any doubt with this, anyone? Otherwise, let's look at the life cycle of a company using the balance sheet. Okay, so let's see again, new projects, if it's in the same location, I'll prefer debt. New project in a new location, strange things can happen. I want flexibility. I'll prefer equity. Okay, I've got a question. Can you please explain cost again? Cost means which one is more expensive, which one is more cheap. Now, as a banker, when you give me a collateral, you have an asset. So let's say if it's a car loan and a default, you can go and sell the car and recover the money. So the risk for the banker is less. So he will expect a lower return. Equity shareholder, I'm standing last in queue. First, you will pay to your lenders, then you pay money to your preference shareholders. Something is left, then I get the money. So I'm bearing the maximum risk. So I will not be expecting like 10% or 12%. My expectation will be more. So equity is more expensive and debt is cheap. Yeah. Let's look at the life cycle of a company with respect to the balance sheet. So just like a product, a company will also go through the introduction stage, maturity stage, and the decline stage. So maybe you'll have this as your introduction stage. Then you'll have the growth phase. You'll have the maturity phase. And finally, the company starts declining if it doesn't adapt to the new conditions. Now, what will happen at the introduction stage? As a young company, as a startup, if I look at my shareholders' funds, I'll be a company where my losses will be there. So my shareholders' funds will be negative. Okay. And I will have very little debt because I'm not having a lot of sale. And if I'm not having a lot of sale, I'll end up having less of debt. So I'll have less of debt. And as far as the asset base is concerned, even the asset base will be low because I'm just a startup. So it's not that I'll have assets worth 10,000, 20,000 crores. Maybe I'll have assets worth few lakhs or maybe just few crores. So shareholders' funds will be negative because it's a loss-making entity. I've just started my business. I don't have enough money to take debt because if I take debt, there's a fixed commitment. So I don't want to get into that debt trap. So I'll have less of debt or maybe zero debt. And my asset base will also be extremely low. But as I move from the introduction stage to the growth stage, what will happen? Slowly and steadily, from a loss-making entity, I'll move into a profitable entity. So my shareholders' funds will become positive because that reserves and surplus, which was negative, now becomes a positive number. Similarly, again over here, because I'm still expanding, whatever money I generate, I invested back into the company. Again, I'll have very little debt or maybe no debt at all, but my asset base will start increasing because I'm expanding, my assets will go up. As I move to the maturity stage, that is when my debt taking capacity goes up. So that is when I'll start taking debt because I have a decent market share. I am generating profits. I'm minting money. I can take loan. I can repay the loan on time. Asset base will be more or less stable, or even if it's increasing, it will not be increasing at a very fast rate. So it's not that your assets will increase at, let's say, 40-50% year on year. So asset base will be increasing at a very fast rate during the introduction and the growth stage. because as a company, you want to expand yourself. So you will have less of assets. So maybe you've got assets worth 1 crore initially, but next year you could have assets worth 2 crores. So your growth rate is 100%. But when you move to the maturity stage, you already have assets, let's say, worth 10,000 crores. Next year, you'll not have assets worth 20,000 crores. Maybe you'll have assets worth 10,500 crores or 10,200 crores. So asset base will increase, or it will be stable. And if it's increasing, the growth rate will be very low. Declining stage, you again end up making profits. I mean, you end up making losses. So your shareholders' funds could again become negative. You will start repaying your debt. So your debt will start going down, and then you'll start selling your assets. So your assets base will also start going down. So this is what will happen with a typical company in the introduction stage, growth stage, maturity stage, and the declining stage. At real life companies, declining stage. Okay, I've got a question. Explain declining stage. Now, declining stage, company is not doing well. Now, if the company is not doing well, the people are not liking your products or your services, you will end up making losses. So what will happen? Your shareholders' funds will again start going down, and over a period of time, it will become negative because of the losses that you will be incurring. You will start repaying the debt, because if you don't repay the debt, then you could get into a liquidation phase. And as far as assets are concerned, again, your assets will be low because you are shrinking your business. Any excess asset that you have, you'll try and dispose and get rid of it. How does a shareholder benefit in such a condition? A shareholder doesn't benefit in a declining stage. A shareholder will basically benefit in the introduction, growth, and the maturity stage. Now, okay, I've got a question. In the declining stage, debt may increase. Now, in the declining stage, if your debt increases, then it's a big debt trap for you. Your markets are going down, your profits are going down, you're not generating enough cash. Why do you want to take more debt? If you're taking more debt, you're just increasing your risk further, that you would get into liquidation, and finally you'll get into BIFR, which is Board for Industrial and Financial Reconstruction. Okay. Now, let's look at real life examples of companies which could be at the introduction, growth, maturity, and decline. So let's look at companies. Let's look at the first company which I've taken, which is a company named Peloton. Now, this company is basically into fitness equipments. They came up with their IPO, I think, in 2020. So it's like a young company. It's at the introduction stage. Now, if you look at this company, what is happening in this company? This company, just give me a second. Yeah. So this company, if you look at the asset base in 2019, their assets were only 864, but then it expanded to 2981. So look at the way their assets are increasing. The assets have gone up by like 3 to 4 times at the introduction stage. And the biggest asset for them is their cash and cash equivalent. Because when they come up with an IPO, you have a lot of money. You haven't invested that money as of now. You haven't bought a lot of assets. So you're sitting on a huge cash pile. So you're sitting on a huge cash pile. Your asset base is small, but it's increasing at a very fast rate. Okay, I've got a question. What is goodwill in asset? Goodwill is nothing but, let's say if I, as a company, buy out another company. And when I'm buying out another company, let's say I'm taking assets worth 100 crores, but I'm ready to pay 120 crores for the company. Now, I'm not an idiot to pay 120 crores just for a company which is worth 100 crores. Why am I paying that additional 20 crores? Because I know that if I get that company, I'll get access to more market. My economies of scale will happen. I will get negotiating power. I get better access to technology, and therefore I'm ready to pay that premium. So that premium is known as goodwill. So that gets recorded in your balance sheet. Okay, I've got a question. Is it possible for a normal person to view the assets and liabilities of a company? You can go to any company's website. In the annual report, you will get the assets, liabilities, the cash position, the cash flow statement, everything. So this is publicly available information. I've gone to the website of Peloton, I've downloaded their annual report, and there I can see the asset and the liability position. Okay. Now, Peloton is at the introduction stage. So at an introduction stage, like I said, your asset base will be small, but it will be growing at a very fast rate. So this is what happens with a company at the introduction stage. Similarly, if you look at this company will make losses because of huge, let's say the losses that I have. So the reserves and surplus is negative. And then because I've raised money by issuing additional shares, so the number becomes a positive, but I'm still a loss-making entity. So initial years, I'm still a loss-making entity. My shareholders fund could be negative, but if I raise a lot of money, then it could become a positive number. Then let's say if I look at another company like maybe Netflix is at the growth stage. So if I look at the growth stage, then you will realize that what is happening is that this company's assets, if I look at the total assets, so the total assets from 25 have gone up to 33. So it's increasing, but it's not increasing at the same rate as it was increasing for Peloton. So the rate over here is also high. Maybe it's expanding at 40-50%. So asset base is increasing, but not like Peloton, which was like 300-400% year on year. And in this company, you have something which is like a non-current content asset, and you have something which is a deferred revenue in the liability side. Again, I'm not looking at each and every line item. Something that I feel is specific, I've just highlighted that, and I'm just discussing those line items. So in the asset side, they have non-current content asset. This is nothing but the content that they have, which they show. So those movie rights, those show rights that they have, which is an asset for them, that's nothing but a non-current content asset. And this is an intangible asset. I can't touch, feel, and see that. Okay. So that's an intangible asset. And this deferred revenue is a liability for them, because when you take a subscription for Netflix, so let's say I take a subscription of Netflix for a year, then I pay money in advance to the company. So I've paid money in advance to Netflix, but Netflix is yet to render its services for the next 12 months. So they've received the money in advance. That's a liability for them. So this is that deferred revenue. So deferred revenue is the money that they've collected in advance, yet to give the services. Non-current content asset is the assets that they have in terms of shows and movies and all of that they have. So this is their balance sheet. Then maybe we could look at a company like, let's say, Coca-Cola. So if you look at Coca-Cola, look at the asset base from 83, it has gone up to only 86, not even increasing at, let's say, 10% year on year, because it's at the maturity stage. This company has goodwill in its balance sheet, which means this company has purchased another company. And when they purchased another company, what they did is they paid a premium for that company. So they have paid a premium, and therefore they have goodwill in their company. Equity method investment, the company has done investments in some other company. They've bought bonds, debentures, shares of some other company. That's nothing but an equity method investment. And they also have something which is known as a deferred tax asset. So deferred tax asset, if you have, it tells you that in future, the company will have to pay less tax to the government. This company also has something which is like a treasury stock. Anyone who can tell me what's a treasury stock? If you have an idea, otherwise I'll tell you what's a treasury stock. Treasury stock is nothing but buyback of shares. So what's a buyback of shares? I've issued shares to the public. Let's say I've issued 10,000 shares. Then after some time, I feel that my stake in the company is low, and therefore I want to increase my stake. Or there could be other factors because of which the company will buy back the share from the people who are already holding the shares. So let's say you hold 100 shares, I hold 100 shares. I want to increase my stake in the company, and I'll come and tell you, can you sell 20 shares to me? Current market price is 1,000. I'm ready to pay you 1,200. And so if you feel that you need money and it's a good offer, you might sell the shares. because the current market price is 1,000. I'm giving you 1,200. So it's an attractive offer. You sell the shares to me. So now you will have only 800 shares. I'll have 1,200 shares. So that's a buyback. So a treasury stock, which means the company has done a buyback in the year. They bought back shares from the public. Finally, if you look at a company like, let's say, Toyota is towards the fag end of the maturity stage, not yet moved into the declining stage, but at the fag end of the maturity stage. Look at what's happening in the company. Look at the growth rate in the assets. The growth rate in the asset is not that great. From 51.93, they moved to like 52.68. So the asset base is almost the same, or if it's increasing, then it's increasing at a very, very slow rate. Okay. Similarly, if I look at, let's say, the liabilities, now this company, instead of having a deferred tax asset, it has a deferred tax liability, which means in future, the company will have to pay more tax. So again, just a recap, introduction stage, I will have less assets, but those assets will be increasing at a very fast rate, and my net worth could be negative, shareholders funds could be negative. As I move towards the growth stage, asset base will expand, but the growth rate will not be 300, 400%. Maybe it will be 40%, 50%. And my net worth or shareholders fund, which was negative, will move into profit zone, move into the growth stage, maturity stage, and the declining stage. Asset base will increase, but the rate at which they will increase will be very low, or it will be constant. Declining stage, in fact, the asset base might shrink because you are trying to get rid of your assets. Any excess assets that you have, you want to sell it off, and you want to shrink and bring down the size of your business. So any doubt with the balance sheet before we move to the income statement? Anyone? Yep. Deepak, you said kind of asset. Can you just tell me what do you mean by that kind of asset? Yep. Anyone else? Any other doubts with the balance sheet? Otherwise, we can move to the income statement. Okay. Now, the treasury stock is I'm buying back my share capital. So my share capital will go down. So let's say I had shares worth 1,000 crores. If I'm buying back the shares, the share capital will not be 1,000 crores. It will become like, say, 950 crores or 900 crores. So my capital will go down. Okay, I've got a question. If net debt is zero, does it mean that the company is profitable? No. What do you mean by net debt? Net debt is debt minus cash. For example, you look at Tata Motors, you look at Reliance. They have made statements that over the next 5 years, they want to make the net debt zero, which means the total debt minus the cash balance that they'll have will be zero. Doesn't mean that the company is a profitable entity. In case of Coke, assets and liabilities are balancing. Assets and liabilities will always balance because the name suggests it's a balance sheet. So balance sheet has to balance. Assets will be the same as liabilities, something that we discussed in the first 10-15 minutes. And we said that assets and liabilities will be the same. Okay, where would bonus shares get reflected? Now, what are bonus shares? Bonus shares are shares which are issued free of cost. So let's say I am a company like ICICI Bank, I issue bonus shares. So when I issue bonus shares and I am a shareholder of ICICI, I will get additional shares. So the share capital of the company will go up, but at the same time, the reserves and surplus for the company will go down. So equity share capital, let's say it was 100, will become 150. Reserves and surplus, let's say it was 200, will go down by 50 and it will become 150. So this is something that will happen when you issue bonus shares. That is shares which are issued free of cost. The shareholder doesn't have to pay money for them. So the company gives you shares just like that. Okay, so let's move to income statement now. Let's look at an income statement, how companies make an income statement. So again, like I said, income statement will talk about revenues, minus expense, which will give you the profit or the loss for the company. Now, how does a company show it? Again, they'll make it in a vertical format. So they will have something like revenue from operations. So let's say if I'm looking at a company like Asian Paints, so the revenue that I generate from my paint business by selling paints will come over here. That's revenue from operations. Then I'll have other income. So let's say Asian Paints has invested money in some other company and they've got some dividend. They've bought some bonds or debentures of some other company. So they're getting interest income. So that's got nothing to do with their paint business. They have invested money because of which they're getting additional money. That will come as other income. Put together, they'll have revenues. Then they'll have the expense. So under expense, typically what they will show is a company will show the material cost. Maybe they'll show the employee cost. And then they could just write other expenses. So material cost, the cost that you're incurring for producing the finished product, employee costs, the salaries, the wages, the pension, the gratuity, training expense, all of that will be a part of employee cost. And all other expenses get clubbed together. So maybe insurance, electricity, telephone bills, or anything else will get clubbed together and they'll show it as other expenses. So they'll show all of this. And finally, what you get is your profit before tax, which is PBT. That's profit before tax. From this, the company will pay the tax, that is reduce the tax, and what they get is PAT, which is profit after tax. So this is the profit for the company. So this is how a company will basically show their income statement. I'll take the revenues from operations, I'll take other income, add it up, get the total revenue. Then I'll reduce my material cost, employee cost, and other expenses. So this is nothing but the total of the expenses. Revenue minus expense will give me the profit that the company has before the tax that it has to pay. It will reduce the tax and it will give me profit after tax. Any doubt with this? Otherwise, again, we move back to, okay, how does a company strive to stay in the growth stage always? Again, it's not possible to stay in the growth stage always. Companies will decline. Again, let's look at ourselves. I mean, when we were born, that time, and depending upon how old you are, can you say that you'll always be a teenager? No. Slowly and steadily, you will move to another phase. So from a teenager, maybe you'll move to a stage where you move into a married phase. Then from that stage, maybe you'll become a father or maybe a mother. And then slowly and steadily, you'll become old and you will die. So this is something which happens with companies also. So companies will try to come up with something new. So they'll try to come up with a new product so that they can keep themselves in the growth stage. But the question is, if the customer doesn't like that product, then slowly and steadily from the growth or the maturity stage, you'll move to a declining stage. So you'll try to reinvent, you'll try to come up with new products, you'll try to do new things. As long as things go well, you can be in the growth stage or the maturity stage. Things don't go well, you move into the declining stage. Okay, I've got a question. There are companies since ages with more or less the same product. Now, companies are there with the same product, fine, but then it's a product which is like a basic necessity, and I need that product. So if I need that product, even if I'm selling that same product for year on year, it's fine. But then if there's one more company which comes up with a better quality product, which is being produced by you, I mean, you'll collapse. Maybe within a year or 2 years, but you'll have to change, you'll have to upgrade yourself. Otherwise, you'll just go down the drain. Okay, I've got a question. Tata Motors is old, but the shares have hit rocket high after real long. So basically, buying Air India new cars help them in increasing the value. It's got nothing to do with Air India. Tata Motors stocks have been doing well because if you look at their portfolio of cars over the last 3, 4, 5 years, they have just revamp themselves. I mean, I still remember in the 90s and the 2000s, they had what? Indica, Indigo, Tata Sumo, and all these cars. Look at the portfolio of cars over the last 4 5 years. They've come up with new cars, better cars. The cars, as far as safety ratings are concerned, they're far better. And look at the way they have like a first mover advantage in the EV segment, electric vehicle segment. And they've got huge funding for that EV segment also. So this is something which is pumping up and raising the share price of Tata Motors. Okay. So again, let's just go back to the same set of companies and look at what happens to different companies as far as their income statement is concerned in the life cycle. So again, when I'm looking at an income statement, again, the same thing: introduction, growth, maturity, and decline. Now, what will happen at, let's say, the introduction stage? Introduction stage, revenues will be small or less. Cost will be there. I'll end up making a loss. So at the introduction stage, I'm not selling a lot of products. I'm not providing a lot of services, but the cost is there. I'll end up making loss. Slowly and steadily, as I move towards the growth stage, revenues will start going up. Cost will also go up, but then cost will not go up in the same proportion as revenues, and slowly and steadily I'll move into a profit zone. So as companies move from introduction stage to the growth stage, slowly and steadily from a loss-making entity, it will move into a profitable entity. You move to a maturity stage, revenues again will increase, but the rate at which they will increase will be low. So I am a company which has a decent market share. I'm not expanding aggressively. So my revenues will be more or less stable. So they'll increase by, let's say, 5%, 10%, but they'll not increase like 40, 50, 100% year on year. So revenues will increase, but maybe they'll increase at a very slow rate. Again, over here, what I'll get is economies of scale, and therefore my profits will be high. So I'll have a lot of profits over here because of high revenues, economies of scale, which will bring down my costs a little bit, and my profits will be high. Move to the declining stage. Declining stage, your market share is reducing, customers don't like your products, and therefore what will happen is your revenues will go down. And as a result, what will happen is slowly and steadily your profits will go down and you'll end up making a loss. So this is what will happen as far as the income statement is concerned and how it is linked to the various stages, be the introduction stage, growth stage, maturity stage, or the declining stage. Again, if I go back to those companies and I start looking at, let's say, the income statement. So let's say if I'm looking at Peloton. So you look at Peloton, what's happening? It's at the introduction stage, but look at the way their revenues are increasing from 400 goes to 900, then it goes to 1800. Year on year, it's increasing at like 100% rate. But look at the profitability, it's a loss-making entity. So introduction stage, you will end up being a loss-making entity. Let's look at, let's say, Netflix. So if I look at, let's say, Netflix, where's the income statement? Give me a second. Yeah, so this is the income statement. So if I look at Netflix revenues are increasing, but then they're not increasing at the same rate at which it was increasing for Peloton, which was at the introduction stage. It's not increasing 100% year on year, but it's still increasing, let's say, at 40, 50% year on year. So revenues will increase, but the growth rate will slowly go down, but it will still be high, 40, 50%. And look at the profits. Now the company is into a profit zone because at the growth stage, you will make more revenue. Cost will not increase that much. Therefore, you move into a profit zone. Look at, let's say, a company which is at the maturity stage, maybe like a company like Coca-Cola. So if I look at their income statement, So if I look at their income statement, look at what's happening. From 36, it has gone to 37,000, and that too over a period of 2 years. So over here, the growth rate is not even, let's say, 10% or 5% year on year. So for Peloton, it was like 100% year on year. Netflix, it was like 40-50% year on year. Coca-Cola, it is like 2-3-4% year on year. And look at the profits. I've got huge profits compared to, let's say, what I have for a company like, let's say, Peloton or any other company. And finally, if I look at, let's say, Toyota, I'll just move to the income statement. Yeah, so if I look at the income statement from 29.92, it has, sorry, from 29.37, it has gone to 29.92. So again, growth rate in revenues is abysmal. It's not increasing at a very fast rate. And finally, if I look at my net income from 2.58 has gone down to 2.14. So the profits for the company are going down, giving an indication that company could fast be approaching and moving towards the declining stage. Okay, I've got a question. Sometimes in balance sheet, the facts are not in the line with actuals. In books, they have cash, but in actuals, they don't have. How to catch these? Now, again, this is something which is of late has come up, because a lot of companies, what they do is they do window dressing. So for example, let's take a case, Satyam. This is what Satyam did. They were showing that they have a lot of cash, but they actually did not have a lot of cash. So you have ways and tools to find out whether there is something wrong in the company. So for example, let's look at a cash flow statement. And when I look at a cash flow statement, I try and compare it with my income statement. Now, cash flow statement will basically talk about the cash. Income statement will talk about the revenues. Now, in a cash flow statement, when I look at my cash from operations, and in my income statement, if I look at my profit from operations, they should be more or less close enough. So it should not happen that my profit is 1,000 crores, profit from operations is 1,000 crores, but my cash from operations is only 10 crores or 20 crores. It gives me a clear indication. It raises a red flag. Something is wrong with the company. So look at such things where you start comparing and looking at, let's say, your cash flows with the income statement. If it's more or less 70 to 80%, it's close enough, it's fine. Because there'll be years when profits will be more, cash will be less, or cash is more, profit is less. But there is too much of a difference on a consistent basis, then definitely it raises a red flag. Something is wrong in the company. Balance sheet is not validated or approved by a third party. Balance sheet and the income statement and the cash flow statement gets audited by an auditor. And then again, we know what has happened in the past. So there are big brands, I don't want to name them unnecessarily. The big four, they were involved. One of them was involved in the Satyam case. And, so again, I mean, you will have to do your own cross checks. Just because there's an auditor who's doing the vetting and saying that he feels that the books of accounts show a true and fair view, doesn't mean that you trust them blindly. So you will have to do your own analysis and decide whether it makes sense or not. So even if the auditor says that according to him everything is fine, but you have a gut feeling, no, something is wrong, just stay away from that company. Okay, what a question saying sometimes revenues increase due to merger and all, but net profit does not increase so much. So in that case, is it a growth for the company? Now, again, let's say I've got two companies, A and B. Now, the company that I'm acquiring is, let's say, at the introduction stage or is at the initial stages of growth. So revenues are increasing. So when I get clubbed with that company, my revenue base will increase. But because that company is still at the introduction or the initial stage of the growth phase, the profit profits are not that high. So maybe that company is still a loss-making company, but the future looks good, and that's the reason why I bought that company. So that could be a factor why revenues will increase, but your profits may not increase because that entity is still a loss-making entity. Yeah. Okay, I'll just switch off to the whiteboard. Yeah. Yep. Anything else? So today we discuss the basics of the financial statements, which is a balance sheet. In a balance sheet, you have the asset side and the liability side. Asset side, you could have non-current assets and current assets. Liabilities, you could have non-current liabilities and current liabilities. Along with that, you'll have the shareholders funds, which will consist of either equity share capital, preference share capital, and reserves and surplus. Then we move to the income statement. Income statement, companies report as let's say revenue from operations and revenue which is not from operations, which is other income. Put together, they'll show the total revenue. Then they will reduce all the other expenses. What they get is PBT. Then they reduce the tax, and finally what they get is profit after tax. Now, if I want to do the analysis for a company, and if I'm looking at the income statement, I would slightly modify the income statement. I'm not going to look at the income statement the way the company makes. I'll slightly modify it and make it the way I want so that it becomes easy for me to do the analysis. Okay, I've got a question saying, what does trade volume depict? Trade volume talks about the number of shares which are being bought or sold. So if the trade volume is high, you're saying that the liquidity for the company is high. If the trade volume is low, you're saying that the number of people who are buying and selling the shares in the company is low, so the liquidity is low. So let's say if you have a share in a company where the liquidity is very low, you might find it difficult to sell the shares because you may not find a buyer to buy your shares. So you are ready to sell, but someone else may not be interested in buying the shares. So that's typically your trade volume. Now, if I want to just slightly modify the income statement, how do I slightly modify the income statement? I will look at my sales, which is my revenue from operations. From this, I will reduce the cost of goods sold, which is the cost which is incurred to produce that product or manufacture that product. This will give me the gross profit. Then I will reduce other operating expense, such as your administration expense, your selling and distribution expense. So cost of goods sold is basically the expense which is incurred in the factory. So I'll take my sales, I'll reduce the factory expense, and I'll get the gross profit. Then I'll reduce the other operating expense, such as admin expense and selling expense. This will give me operating profit. So this tells me the profit that the company is generating from its day-to-day operations. From this, I will do adjustments for non-operating income and non-operating expense. For example, in Asian Paints, they have dividend income, interest income. That will come here because it's not from my day-to-day operations. I've got a non-operating expense. Maybe there's some loss because of fire, there is some theft or something that's got nothing to do with my day-to-day operations. So all of that will come here. And finally, I'll say, okay, this gives me my profit before tax. I will reduce tax and I'll get my PAT. So I've just modified it so that it becomes easy for me to understand how the company is performing. So I haven't changed anything as such. Companies will show it as revenue from operations, other income, reduce the expense, and get the PBT. I've just split this part into different categories so that the analysis part becomes easy. That's it. Okay, I've got a question. Does estimation for an entire project that has not been completed yet falls under non-operating expense? See, what's a non-operating expense? A non-operating expense is something which doesn't deal with your day-to-day activity. Let's take an example. Let's say I'm a company like Asian Paints. Now, what's my business? My business is to produce paints and sell paints. So for paints, one basic ingredient is oil. I'll need oil. Now, that is my day-to-day operational activity. I'll purchase oil. That's my operational expense. But let's say Asian Paints has some furniture which it bought 10 years back, and now they want to get rid of it and they want to buy new furniture. And that's not their day-to-day business. When they sell the furniture, they sell it at a loss. So that will be a non-operational expense. So that's how you categorize and identify whether it's an operational expense or a non-operational expense. If it's related to your day-to-day business, it's operating. Otherwise, it's non-operating. Okay, what is it that you're showing as a deduction from gross profit? I'm deducting administration expense and selling expense. These are other operating expenses. One operating expense is incurred in the factory. Other operating expense is your admin expense and selling and distribution expense. Okay, electricity bill and telephone bills, is it operating? Yes, it's operating expense, because otherwise how do I run my day-to-day operations? Okay, what is EBITDA? EBITDA is earnings before interest, tax, depreciation, and amortization. So if I slightly modify this format that I have made, and I don't consider depreciation of the factory, I don't consider depreciation which is incurred in the admin department and the selling department, then what I get over here is my EBITDA. Then from EBITDA, I'll deduct depreciation. I will get EBIT, which is earnings before interest and tax. Then I'll reduce the interest, and then I'll do adjustments for non-operating income and expense. I'll get my PBT. So that's EBITDA, which is earnings before interest, tax, depreciation, and amortization. Yep. Any other thing? Otherwise, we are okay. I've got a question. What is a capital expenditure? What's a capital expenditure? A capital expenditure is a long-term expenditure. So when a company does an expenditure to buy some property, plant, equipment, land, and building, that's a capital expenditure, because this expenditure will be used to buy an asset which will be used for a long-term purpose. But if an expenditure is being done which will help in generating benefit only for the short term, then it's a revenue expenditure. So I buy raw material, that's a revenue expenditure, because I'll use it to produce goods and sell it, and I'll get the benefit within 1 year. So that's a revenue expenditure. Buy machines, that's a capital expenditure. I can use the machine for 10 years, 20 years, 30 years. So that's a capex, capital expenditure. Okay, question. What are the topics to be covered for the next internal assessment, and what would be the format? Now, again, IAs, as far as the first IA is concerned, just give me a second. I'll just cross-check and let you know. IAs, there's something which is clearly mentioned. Just give me a second. Yeah, so your IA1 will be based on the async content for the live session 2, which means basically it will be on your accounting principles and your financial statements. So that is what you will have in your IA1. Next question is, do we get to learn forecasting and planning? No, forecasting and planning as such is not included over here. It will get covered in let's say when we move to the last part, which is your ratios, and we move to comparative and common size. So there we look at the planning aspect. We don't look at the forecasting part, but ratios to some extent will help me in forecasting and understand what is happening in the company or what will happen in the company in future. So ratios and comparative and common size to some extent will cover forecasting and planning. But we are not getting into the nitty-gritties of, let's say, a financial modeling where you tell me that, okay, forecast and tell me what will be your balance sheet and your cash flows and your income statement for the next 5 years, 10 years. No. So that's not a part of your syllabus as far as financial modeling and forecasting is concerned. You will have multiple choice questions. Yes, you will have multiple choice questions. Along with that, I think there is a descriptive question also. Yep. Anything else? Otherwise, we are fit to call it a day. Yep. So there's a feedback link that has been sent. Would request you to just fill it up. Okay. Yep. Thanks. Thanks a lot. It was nice interacting with you all. Thanks a lot. Okay. Bye. Take care. Paranjay, can I leave?
Yes, sir, sure.
Okay, fine. Thanks. Bye.
Thank you, sir.